Warren Buffett just did something he has never done in 60 years of running Berkshire Hathaway. And if you understand what it means, you'll realize this could have serious implications for your retirement account. The greatest investor alive is sitting on $344 billion in cash and refusing to deploy it. And when the man who turned $10,000 into $5 billion over his lifetime suddenly stops buying stocks and starts hoarding cash, like the apocalypse is coming, you need to pay attention, because history shows us exactly what happens next, and it's not pretty. Let me show you the actual numbers that Wall Street doesn't want you to see. Buffett sold $134 billion worth of stocks in 2024 alone. To put that in perspective, that's more than the market value of Netflix, Adobe, and Salesforce combined. He didn't just trim positions, he liquidated. Buffett sold 67% of his Apple stake, the stock he once called better than Coca-Cola and American Express. This is Apple, the company that made him $96 billion in gain. The investment he said he wished he could own entirely, and he dumped 2/3 of it. But it's not just Apple. Buffett also cut his Bank of America position by 39%, the bank he invested in during the financial crisis when nobody else would touch it. These aren't minor portfolio adjustments, these are systematic exits from positions he's held for decades. Here's what makes this absolutely unprecedented. Buffett has been a net seller of stocks for 11 consecutive quarters, selling $177 billion more than he bought. 11 straight quarters. That means, for nearly 3 years, every single quarter, he's been reducing his stock exposure and building cash. This isn't market timing, this isn't tax planning, this is Warren Buffett systematically de-risking his entire portfolio while the market celebrates new highs. And if you know anything about Buffett's philosophy, you know his favorite holding period is forever. He doesn't sell unless something fundamental has changed. So what changed? The answer is critically important to understand. The market is now trading at valuations that have only appeared 3 times in modern history, right before the biggest crashes we've ever seen. The Buffett Indicator, which measures total stock market value against GDP, just hit 210%. Let me explain why that number should shows we're in unprecedented territory. This indicator is literally named after Warren Buffett because he called it probably the best single measure of where valuations stand at any given moment. When this ratio approaches 200%, Buffett himself warned you're playing with fire. We're at 210% right now. That's not expensive, that's not overvalued. That's bubble territory that has only been exceeded twice in history. Once in 1929, right before the Great Depression. Once in 2000, right before the dot-com crash that destroyed 78% of the NASDAQ, and now in 2025. But here's where it gets even more disturbing. History shows that when Buffett turns into a net seller, the market significantly underperforms. This isn't speculation. This is documented pattern recognition over decades. When Buffett is buying aggressively, markets tend to do well. When he's sitting on cash and refusing to deploy it, trouble follows. And he's not just sitting on cash, he's sitting on the largest cash pile in Berkshire's history. At the end of 2024, Berkshire held $334 billion in cash and treasury bills, nearly double from a year earlier. Think about that progression. He went from $150 billion in cash before COVID to over $300 billion today. That's not gradual rebalancing, that's panic preparation. The concentration risk in today's market is unlike anything we've ever seen, and it's far more dangerous than people realize. A handful of mega-cap technology companies now represent a staggering percentage of total market value. When 1 or 2 stocks can move the entire market, that's not a healthy market. That's a house of cards. And Buffett knows from experience what happens when markets become this concentrated. He lived through the 1990s when everyone said you had to own tech stocks or you were a fool. He watched as Cisco, the darling of that era, traded at valuations that assumed it would dominate forever. Cisco is still a successful company today, but its stock never recovered to its year 2000 peak. Not in 25 years. That's what happens when you pay bubble prices for even great companies. Here's something that should keep you awake at night. Buffett refused to buy back even a single share of Berkshire Hathaway stock in the 4th quarter of 2024, despite the company generating massive operating profit. For context, Buffett had spent $78 billion buying back Berkshire shares over the previous 24 quarters because he believed his own stock was undervalued. That's more money than he spent on Apple, Bank of America, American Express, and Coca-Cola combined. His own stock was his favorite investment, and suddenly he stopped. Completely. If Buffett won't even buy his own stock, the company he knows better than any other, what does that tell you about how he views the entire market? It tells you he sees better opportunities doing absolutely nothing than buying anything at current prices. The timing of Buffett's moves is crucial, and most people are missing the significance. In February 2025, when Buffett released his annual letter, the S&P 500 had just closed at a record high. Everyone was celebrating. The media was talking about soft landings and continued bull market, and Buffett was sitting on $344 billion in cash, having just sold $134 billion in stock. He wasn't celebrating, he was preparing. And then, what happened? The market entered a correction, falling more than 10% from its highs as Trump's tariff policies created uncertainty. Buffett's timing once again proved prescient. While the S&P 500 fell 11%, Berkshire Hathaway stock rose 12%. Cash suddenly looked very smart. Let's examine the specific investments Buffett has been making with his limited buying, because they reveal his true thinking about what's coming. He's been pouring money into U.S. Treasury bills, which currently yield about 4.3%. At $314 billion in Treasury bills, Berkshire will collect approximately $13.5 billion in interest income in 2025 just from sitting in government bonds. Now, I know what you're thinking. 4.3% returns are boring. You can't get rich on Treasury bills. And you're right. But here's what Buffett understands that most investors don't. When stocks are expensive and likely to fall, earning 4% in safety is better than losing 40% in a crash. It's about preservation first, return second. And the fact that Buffett is choosing Treasury bills over stocks tells you everything about his confidence in current market valuation. The corporate debt situation is another massive risk that nobody's discussing, but Buffett clearly sees. During the years of zero interest rate policy, companies borrowed trillions of dollars at incredibly low rates. They used that cheap debt to buy back their own stock, artificially inflating earnings per share and stock prices. It worked beautifully when rates were near zero. But now interest rates are significantly higher, and all that debt needs to be refinanced at much more expensive rates. Some analysts believe Buffett is preparing for a recession by raising cash now, so he can buy companies cheap later when the debt problems force distressed sale. He did exactly this in 2008 when he deployed billions into Goldman Sachs, General Electric, and Bank of America at crisis price. He made fortunes from those investments because he had cash when everyone else was desperate. Here's a critical lesson most investors never learn. Market crashes don't happen because of warnings, they happen because of valuation. Warnings can be early by months or even years. The Buffett Indicator hit 190% in late 2021, signaling extreme overvaluation. Yet the market didn't crash until 2022. That's more than a year of being wrong if you reduced exposure based on valuation. But here's the thing, when the crash finally came, the market fell and took years to recover. Being early meant you avoided the devastation. Being on time meant you were already down 40% and panicking. Buffett is willing to be early because he knows that eventually, mathematics wins. Stocks trading at twice their historical average valuation will revert to normal. It's just a question of when. The AI bubble is playing out exactly like the internet bubble of the late 90s, and Buffett lived through that disaster. Back then, everyone said the internet would change everything, and they were right. The internet did revolutionize the world, but that didn't mean every internet stock at any price was a good investment. Amazon survived the dot-com crash, but its stock still fell 95% from peak to trough. Pets.com went to zero. Webvan went to zero. Dozens of companies that were supposed to dominate the new economy vanished. Today, everyone says AI will change everything, and they're probably right. But that doesn't justify current valuations where companies with minimal revenue trade for billions based purely on hype. Eventually, revenue and profits matter. Eventually, reality catches up with expectation. And when it does, the stocks priced for perfection are the ones that fall the hardest. Let me explain the psychology that's driving this market insanity and why it always ends badly. When stocks go up for long enough, people start believing they can't go down. Every dip gets bought. Every correction is shallow and brief. Investors stop thinking about risk because risk seems to have disappeared. This is called recency bias, and it's one of the most dangerous cognitive traps in investing. Despite Berkshire Berkshire sitting on a record cash position, Buffett wrote in his February letter that the great majority of money remains in equities, and that preference will never change. Translation: he's not abandoning stocks forever. He's waiting for prices that actually make sense. But most investors can't do what Buffett does. They can't sit in cash earning 4% while their friends brag about their return. They can't handle the psychological pressure of missing gains, even temporary ones. So they stay fully invested at the top and then they panic and sell at the bottom. It happens every single cycle. Here's something crucial you need to understand about how Buffett actually operates. He doesn't try to time the exact top of the market. He doesn't wake up one day and decide today is the day to sell everything. What he does is gradually reduce exposure as valuations rise and gradually increase exposure as valuations fall. He started reducing his Apple position in the fourth quarter of 2023 and continued selling through 2024 as the stock kept climbing. That means he left gains on the table. Apple went higher after he sold. But Buffett doesn't care about maximizing every dollar of profit. He cares about buying undervalued assets and selling overvalued ones. It's a discipline most investors simply cannot maintain because it requires accepting that you'll often look wrong in the short term. The bond market is sending signals that everyone is ignoring, but Buffett clearly isn't. When Trump announced major tariff policies in April 2025, something unprecedented happened. Both stocks and bonds fell together. Normally, when stocks fall, bonds rise because investors flee to safety. But this time was different. The bond market crashed too, sending yields spiking. That tells you something very dangerous is happening in the confidence game that underlies all financial markets. If investors don't trust stocks and they don't trust bonds, where do they go? Cash. And that's exactly where Buffett is, sitting on $344 billion in cash and short-term treasury bills. He's positioned for a world where traditional safe havens stop being safe. Here's what separates successful long-term investors from those who get wiped out. It's not intelligence, it's not access to information, it's emotional discipline and understanding risk. Buffett's favorite quote is that in his world, patience is more than a virtue, it's a weapon. Most investors can't be patient. They need to be doing something all the time. Buying, selling, trading, reacting. But the best investors spend most of their time doing nothing, waiting for the right opportunity. When Buffett made his fortune during the 2008 financial crisis, it wasn't because he predicted the exact date of the collapse. It was because he had cash when everyone else was panicking, and he could buy assets at fire sale price. The profit was made by having the discipline to hold cash through the years leading up to the crisis, even though that cash earned almost nothing, and stocks kept going higher. The final lesson from Buffett's massive cash position is about opportunity cost and patience. Buffett once said that in Berkshire's world, they'd love to spend their cash pile, but they won't spend it unless they think there's very little risk and it can make them a lot of money. Those are his criteria: low risk and high return. Right now, he sees neither in the stock market, but he knows that eventually markets overshoot to the downside just like they overshoot to the upside. When panic hits and prices collapse, that's when his $344 billion in cash becomes a weapon. He'll buy world-class companies at depression prices, make returns that seem impossible, and everyone will call him a genius. But it's not genius, it's discipline. It's the willingness to sit in cash earning 4% while everyone else makes 10 or 15% in stocks, knowing that eventually those paper gains will evaporate and real opportunities will emerge. Warren Buffett is 94 years old. He's seen more market cycles than almost anyone alive. He's lived through the crash of 1973 and 74, the crash of 1987, the dot-com bubble, the financial crisis, and the COVID crash. And right now, he's more defensive than he's been in 60 years. Sitting on $344 billion in cash, having sold $134 billion in stocks, refusing to buy back his own shares. Every action is screaming caution. You can choose to listen to someone with 60 years of proven success, or you can assume this time is different. History suggests it's never different. The details change, but the patterns repeat. And right now, all the patterns are pointing in the same direction: down.